Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 16th of September, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. Welcome to Fed Week. So an important week this week. Looks like, pretty much nailed on that we're going to get the lift off for the rate cuts in here from the Federal Reserve. They meet Tuesday through Wednesday. We get the result on Wednesday. Very much in here now. We've seen a significant shift from the 25 basis points rate cut, which is kind of nailed on, to now more potential for a 50 basis points. And even this morning, a bigger shift on that. The CME Fed tool, even today, shifting further. Now more of a actually pricing in, we'll come to it shortly, but pricing in now more of a chance for 50 rather than a 25. So the market could actually be disappointed, ironically, if we only get 25 this Wednesday. But we'll cover all that. We'll go through, we'll take a look at the bigger picture. We'll do the bigger picture, take a look at the shape of the week in here today. So kicking off in here, we're going to use the macro matters and the weekly recap and outlook. Remember, these are available. We post them in the forums, but they're also available in the below where you are right now in the macro fundamental section. These go out over the weekend, so they went up yesterday. So you can take a look at these, get ahead of the game. Yeah, the more detailed macro watch in here, but we'll concentrate and we'll just go through the weekly recap and outlook, which is kind of the summary of what's pretty much in the macro watch in here, the macro matters, sorry. So US stock markets continue to rebound strongly. We know that tech giants playing a little bit of catch up, having actually, we'll talk about that shortly. There's an article here on the Magnificent Seven, the big tech in here. We've actually seen the rest of the S&P 500, so the 493, other than the Magnificent Seven, play a little bit of catch-up during this kind of sell-off and recovery that we saw through August, September. So, yeah, that's quite interesting. So that's implying that we've got more of the breadth to this recovery in here, which is a positive. It's not all being driven by the big tech in here. Not only have we seen strength and rebounds in US stock markets, but global stock indices as well, and also treasury yields moving significantly lower and nudging at lower end of multi-month yield levels in here, and also the dollar continuing to weakening. That's been a significant factor. Dollar weakness again coming through in here this morning with anticipation of a more dovish Fed, and then also gold hitting record highs last week in here on the back of the weakness, both the weakness in the the weakness in the US dollar, and then also not only the weakness in the US dollar, but also then as like a little bit of a safe haven, because obviously there is a concern that we could be going towards maybe a not so soft landing, towards a harder landing. So it's a hedge against that harder landing as well. So the gold benefiting for both of those, hitting all-time highs. US CPI, as we know from last week, pretty much in line with expectations, but the market kind of liked that. It was choppy on the day when we got the data back on, it was Wednesday, right? Tuesday, Wednesday. And then, but it resolved itself to the upside, and expectations of at least a quarter of a point Fed rate cut, but now moving closer to a 50. And that's what we're covering in here. Growing anticipation of a 50 basis point cut now at this Wednesday's meeting. And looking back to last week, we did get the ECB. They did lower rates in here as anticipated in here. Bank of England expected to keep rates unchanged, which we get this week as well. So it's not just a Fed. We actually have 4 central banks in play this week. We get the Federal Reserve in here, as mentioned, on Wednesday, Bank of England on Thursday, and then on Friday we get both the Bank of Japan and the PBOC, the People's Bank of China. So we've got lots going on from central banks, and the Fed is obviously front and center. So what happened last week? Well, global financial market developments. Oh, that shouldn't be there. That's up there. It's duped. So global equity averages significantly higher. European and US government bonds moving to lower yields on the week. The US dollar weakened towards multi-month and now hitting multi multi-month lows now. Gold futures at all-time high, and oil futures hit another multi-year low before they bounce. And that's important as well, because oil in here is pointing south in here. Expectations for oil prices to stay at these low levels, and that's a positive, obviously, for the soft landing, because oil is basically like, it's not a tax, but it's like a tax. It's a cost that lots of businesses, lots of individuals, consumers have to pay, right? And it's a drain effectively on potential growth. So a low oil price is seen as a positive for potential growth going forward. As I said, in here, you've got 4 central banks in play in here: Wednesday, Thursday, and 2 on Friday. Fed, then Bank of England, then PBOC and Bank of Japan. On the data side, it's relatively white. US retail sales and industrial production probably the standout on Tuesday, but that's right ahead of the Fed, so probably not going to have a massive impact in here. UK and EU inflation data on Wednesday. That's the CPI as well. So we get UK inflation and EU CPI data coming out on Wednesday. That'll be ahead of the Fed. So that's going to be interesting as well, to see if we've got inflationary pressures continuing to calm down and cool off in the Eurozone and in the UK as well. So significant data there as well. And then UK retail sales on Friday. So the data is actually fairly light. US retail sales really the standout with industrial production, but that's probably not going to do too much ahead of the Fed on Wednesday. And say also that Eurozone and UK inflation data also on Wednesday. So really, it could be in a holding pattern until Wednesday, until the Fed. US retail sales may do something for us on tomorrow. Today we've got nothing of note coming out, nothing of real significance coming through. And if we go to the daily candle, you can see that actually Japanese holiday and Chinese holiday, South Korean holiday. So Asia's been effectively, most of Asia closed in here so far today. Euro zone calendar has been fairly light. Nothing really is standing out there, and nothing from the US today. So expecting very much a consolidation type day today, given that we've had a strong rally at the end of last week as well, and given that we're going into a major event and then further events, Bank of England, PBOC, Bank of Japan, Thursday through Friday, I think today's going to be a very, very, very quiet consolidation day. For me, risks slightly to the upside, still following through from the strength that we saw at the second half of last week, but certainly pointing higher. Let's run through the 5 things to start your day. Well, we've had this yesterday, the Trump potentially second, it wasn't an assassination attempt, but a potential second assassin in here has been arrested. So that's not really impacted at all on markets. Really, it's been a non-event from the market side in here, although has probably potentially significant implications, potentially going forward on the political side in here. But nevertheless, on the actual economic and market side, financial market side, nothing really, no real significant impact from that. Dollar lower, the 5 things to start your day. Dollar lower, and by Bloomberg's measure, like its index in here, lowest level for 8 months in here, and the yen hitting its highest since July of last year. So that's yen strength is mostly driving that US dollar weakness. 25 or 50 is the big question in here, and markets starting to edge now to closer to 50 basis points. We'll come to that shortly in here. Stocks in steady in here after overnight in here. Second attempt at Trump in here. Trump media rose 10% free market trading after the candidate said he has absolutely no intention of selling his stake. And growth matters in here. US economic growth data as well being highlighted as important going forward once we get the Fed out of the way. This is from Morgan Stanley's Mike Wilson. If the labour data weakens from here, markets can trade with a risk off tone regardless of whether the Fed's first move at 25 or 50. So he's highlighting the risk of negative data impacting negatively on the markets in here once we have the Fed rate cycle starts to take shape and we get an idea of it, because obviously concerns around potential hard landing going forward. Coffee surging in here, futures up 2% in here to the highest level in 13 years. But I don't think that's going to really impact us apart from the price of your cup of coffee. So just running through all of that kind of through the headlines: Fed wages, weakened dollar, and fuel more bond gains. So bond markets up in price, down in yields, lower yields, and a weaker dollar in here. Treasury extend their recent gains, led by the 2-year. So the short end leading the way up higher. Remember, the short end more reactive to central bank activity, the long end more reactive to the economy. Okay, and then central bank in the UK and Japan also decide on policy this week. We've covered that. Fed hits easing week. China economic data continues to weaken in here. Stocks firm, dollar sags as market ups bets on big Fed cut. We'll come and look at all of this in a second. Traders amp up bets on big Fed cut to leave markets split on move. Fed swaps pricing shows a half-point cut hangs in the balance. And we'll look at the Fed Watch tool in a second. Fed wages weakened dollar and fuel. Oh, we've already gone through that headline. Wall Street Strategy says U.S. economy tops Fed for stock rally. So again, this is that Wilson comment in here. One's performance hinges on jobs. Goldman Sachs equities rising on solid macro environment. This in here, Fed ready to unshackle U.S. economy with soft landing at state central bank's first interest rate cut is widely expected. Versus on more focus on what will happen immediately after the announcement. As ever, we're going to be reacting to that. S&P 500 surviving big tech sliders other than towards 493 catch-ups there. So we've definitely seen underperformance more recently from the big tech, from the Magnificent Seven. And this is showing that we're getting this broadening, as I say, this broadening rally. And a broadening rally, you don't want it being led just by those Magnificent Seven. You don't want it being led just by one sector. You don't want it being led just by growth stocks. So a broadening of the rally is a positive for a more sustainable, longer-term rally. So lower rates and economic growth see cyclical stocks a lift in comparison to the growth stocks which we see in big tech. On the overnights in here, not much going on. 7/10 down on the Nikkei, 3/10 up on the Hang Seng in here. Actually, they may be delayed. They might be dated from Friday, given the markets were closed, I think, today. We had the holidays today. In Europe, in here, little going on, really. The UK FTSE and the French CAC, little changed on the day. 0.2 lower on the German DAX. And on the overnights in here, very little going on in here. S&P 500, pretty much flat in here. The Nasdaq's off just very slightly. Here's the Fed Watch tool, though. This is what's most interesting. Remember, this was almost reversed yesterday, at the end of last week. This is, we're now got in here, this left-hand column, 59%, is for the 50 basis points cut. This was almost the opposite when we looked at this back at the end of last week. So the market now, from the Fed Watch tool, pricing in more chance of a 50 basis point cut than a 25 basis point cut, which I think is interesting. And if we go into the end of the year now, we've got still 125 basis points built in, so probably 50, 25, something like that. The market is looking at going into the end of the year now. So that's the bet. And then if you add these two together in here, so we're actually at 64% chance that it's going to be 125 basis points or more. Only a 35% chance in here that we're going to get 100 basis points or less going into the end of the year. And that's keeping yields low. This is the 10-year yield, but as I say, the 2-year yield doing even better. If we look at the bond charts in here, you can see 30-year stays bullish, up at recent highs, as is the 10-year. But if we go shorter on the curve, 5s and 2s, 2s actually breaking to more recent highs in here. So the short end leading the way higher in here. And we reversed our, we had a more negative position the second half through this middle of last week. But given the strong reverse that we saw going into the end of last week, we're bullish in here. The S&P 500 nearly back up to the highs seen back earlier in September and not far off the all-time highs from July. Nasdaq a little bit behind on all of that. As I say, we've had that definitely. We've seen an outperformance by the broader market compared to the growth stocks in here. Well, that's a positive though, but nevertheless still pointing higher. I'm not going to go into any real depth in here. For me, it's more of a consolidation day today. I think we might go and test the highs from the end of last week, from Friday's highs, but I'm not expecting much more than that. Maybe test the highs and maybe nudge a little bit higher. Or if we dip lower, I think we're only dipping back into Friday's range. Don't expect to be down at Friday's lows. Good chance we either get an inside day today, so inside patterns, inside Friday's range, or maybe even nudging it. I think the risk is we nudge to the top end of Friday's range, but don't look for too much in the moves in here today, guys. I really think it's a real consolidation day. Say a lot of Asia was on holiday. We got the Fed on Wednesday, further central banks after that. No real data from the US today, so looking for a consolidation, grindy type day. So adjust trading strategies accordingly, or if that's not your type of trading, if you need more of a bit more volatility in the market and a bit more movement and momentum trades, then today's not the day for you, I would suggest. So I would be sidelined waiting for, they're going to definitely get more opportunities along those lines later in the week when you're likely to get far more significant momentum and far more significant volatility through the Fed and beyond, through the other central bank activity as well. All right, guys, I'm going to leave it there. I'm going to wrap it up. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back. Actually, Duncan will be back with you tomorrow for another bull versus bear webinar. Bye.